Hello and welcome. I want to take a minute to go over this amazing console that we will be using so that you get the best experience during the webcast. This console is fully customizable. You can reshape, resize, and move all of the windows. The widgets for today's webcast are the presenter slides and media player, where you will view the webcast presentation. We have the Q&A to ask questions that the presenters will be answering throughout the webcast. The speaker bio will give you information on the speakers and links to contact them. And in the resources, you will find all of your goodies like your slides, your handouts, and your giveaways. The group chat is where you will chat back and forth with the other attendees. And if you want to tell somebody about this great webcast, but you don't want to leave and miss a thing, that is not a problem, because we have a suite of social media icons to choose from, so you can tweet and post about this webcast. You can even invite a friend with the Refer a Colleague widget, and you never have to leave the platform. The Help widget will open a new window to help you with technical difficulties that you may experience, and the survey will be used at the end of the webcast to let us know how we did, what we can do better, and topics that you would like to see in the future. To clean up your console for better viewing, simply click on the widget for the window that you would like to close. As a few last details, please remember to sign out of or disable all of your pop-up blockers. This is an audio broadcast, so to get the best sound quality, all of the sounds for this webcast should be coming directly through your computer. We are recording and you will be receiving a copy, but you will want to stick around for the live Q&A and special offers at the end. We are excited to have you here today. Please sit back, relax, and enjoy this opportunity to mastermind with your Originator Connect network.
Well, hello and welcome everybody to the next episode of the Originator Connect Network webcast forum series. And we've got a special program for you today. We're going to be working into what do we do in the markets of the upcoming couple of years or couple of months in some cases. And sharing with us is sponsored by RCN Capital, Mr. Stephen, who is going to be joining us to talk a little bit about the differences in the type of market. What do we do in a boom market if it continues to carry forward like it has been? What do we do in a collapsing market if the same kind of pattern recurs that did in 08 and 09 when the real estate market values fell? A couple of quick things, by the way, guys, last chance to, this is intended to be more of a interactive program, more of a discussion with you all as attending. There's over 100 couple folks on from around the country as part of the Originator Connect Network members. So we want to get feedback and guidance and support from all of you as to what you would like to know more information about. So as we jump forward here, we're going to be asking a couple little poll questions just to get a little bit of a feel for who you are. And while we're posting those questions, allowing you guys a couple of seconds to respond, Stephen, why don't you go ahead and kind of introduce yourself to our attendees today?
Okay. Hi, everyone. My name is Stephen. I'm the Business Development Coordinator for RCN Capital. I do a lot of these kind of education sessions. I'm sure some of you who are familiar with the show network that this comes from, and Vince as a coordinator, have seen me at previous shows if you've attended in person. If any of you were lucky enough to have gone to Vegas this past weekend as well, I was there. Eric was as well. If you were able to join us, I'm glad you were able to. Again, next week, I'll be down in Texas at the next show with the Texas Mortgage Roundup down there as well. So if anyone listens to the webcast today, some of the conversations we're having, and is interested about wanting to do more, and you're going to be at that event, absolutely come up and see me at the booth. Come and talk to me. I'll give you my contact information at the end of this as well. If you guys have any questions, you let me know. We'll see where we can go from there, and we'll see how we can build you guys up.
Awesome. All right. Well, the responses from the first question it gave us kind of an expectation. The question was basically, do you expect the market to correct in the next couple of years? Are we looking or thinking that we're going to see the real estate bubble burst in some cases? And obviously, the overwhelming majority of you are on the side of the fence of thinking that we probably will be looking forward to some sort of market correction. All right, the next full question we want to ask you is, do you think you're getting the most possible out of your business? In other words, are you taking full advantage of all the opportunities in your market at this time? And go ahead and take a few seconds to kind of respond to that. Stephen, why don't you share a little bit of the background on where that question really kind of comes from as we were planning for this event?
Yeah, so the whole point of this event is to hopefully help you guys no matter what happens to the market, right? Our goal, obviously, is to help prepare everyone. We saw the overwhelming majority of people, I think it said 93% of the audience said that they think a recession is coming in the next few years, or at least some kind of correction, right? It doesn't have to be a full-blown recession. But they think there's going to be some kind of downward correction, a little bit to the real estate market. And our goal with this question is to portray the other side. If everything continues as it is, how do you get more and more out of your business, right? If you're already maxed out, great. Glad. I'm very happy for you, and I'm a little jealous, to be honest. But if you don't think you're getting the absolute most out of your business, what can we do to help you get there, right? What can I do? What can Eric do? And together as a team, and going to these kind of conferences, going to these kind of events, and more content like this, what can we do to get you guys there? And that's the goal of today, is no matter where the market goes, we want to try to get you to the point where your business keeps building, keeps expanding, keeps thriving, right?
Absolutely. And of course, 94.4% of you, and even higher consistency than the previous question, realize that there's opportunities being left on the table. And obviously, that's what the conversation is really all about. So with that being said, let's get right into it. Stephen, go ahead and fire away. Guys, keep asking questions, post them in the Q&A, and we'll be looking forward to stopping a couple of times through the program to address those questions and concerns as we go.
Perfect. Like I said, I'm a little jealous of the 5.5% of you that said you're fine how your business is now. That's a great place to be. If that changes, we'll see what we can do to help you. The other 95% of you, the goal here is to try to figure out where's the U.S. economy going, and then specifically where's the U.S. real estate market heading, right? There's fundamentally two options. I'm sure a lot of you have read a lot into the topic or talked with other people who know a lot about it. Realistically, we see two options. Either the U.S. economy is going to see a recession within the next few years. Common numbers you'll hear thrown out are somewhere by the end of 2020. Sometimes people think it's earlier, a little bit later, somewhere in that rough range. And then the other side, obviously, is if there's no recession, the U.S. economy just keeps growing, as it has been for the last few years. And really, that's what we're going to try to get down to and go through is we want to be able to help you guys build your business, continue to thrive, continue to excel and expand, no matter which one of these is true, right? So we're going to try to lay out at least the beginnings of a path, no matter which option happens. So you can be prepared for in 12 months, if we start to see a slight downturn, especially in your local market, what can you do about it? And then if you are looking in 12 months, 2 years, 3 years, and you see no sign of downturn, what can you do to keep expanding your business as you have been? And hopefully give you a few more avenues, especially for the 95% of you. I mean, we're in a great market right now, and this should hopefully help you guys get even more out of your business than you are right now, right? That's the goal.
Absolutely, absolutely. I mean, that's really what it's all about, guys. The Originator Connect Network is all about bringing a community of originators together, masterminding and brainstorming ways to help you individually grow your business. And, Stephen and his team there at RCN have done an amazing job of really providing some amazing resources and being a great supporter of the network. And we expect to continue that well into the future here. So, Stephen, you had a couple of informational points to kind of go over to begin with, just to kind of give the audience a sense of awareness as to where this all could play out. What are the polar opposites of the spectrum of opportunity here?
Yeah. So from my experience talking with some experts in the field, talking with people that have a lot of experience that lived through the recession themselves, were originators during the recession, actually partly from my conversations with Eric himself at previous conferences we've been to together. It's just a lot of people I talk to that lived through the recession, that have the experience built in, expect some kind of market correction within the next few years. Most people I talked to said within the next 5. A handful of people I talked to say, within 6 months to 12 months. It can be kind of all over the place within that range. Now, there's a couple key things, because anytime someone hears the phrase recession, anytime you hear market correction, people get nervous. And that's absolutely fair to get nervous, right? That's good. It means you're intelligent. It means you're thinking through everything, right? Now, there are a couple things we do want to keep in mind. This is not something that we necessarily expect to hit the real estate market as hard as it did in 2007 to 9, right? Right. We saw a lot of issues that led up to that in 04, 05, 06, and we kind of saw that coming, right? There's a lot of things that stuck out to people that were going to cause issues, and we knew it. So one of the biggest things that comes up in terms of causing a recession or causing a market correction is just the age of this economic expansion. So currently, most experts use the date of June of 2009 to be the end of the recession from a financial standpoint. So that means our current economic expansion is almost 10 years old, which would be the second largest in history. Now, using that as a benchmark, while I acknowledge what they're going for, real estate and the economy in general goes in cycles. But just like anything else, economic expansion doesn't die because of old age, right? It dies because we stop taking care of it. There's a whole bunch of different ways that we can stop doing that. And you see a lot of them in the past recession. You see a lot of them in economic issues in other countries, right? You see bubbles like we did in the mid to late 2000s. We see policy positions that are interesting, weird, incorrect by central banks, right? It's just to phrase it like it is. And then you also see problems with shocks to key resources. So things like labor, things like oil, all of these kind of things, or even credit and debt, really, in terms of usability as a resource, you see shocks to all of those from either a supply or a demand side, right? Mm-hmm. Now, on the demand side, a lot of times it's caused by a lack in an income or a wealth loss. So those are two things, obviously, with an investor group that we'd be trying to prevent. Now, from the people I've talked to, one of the biggest causes we expect, or they expect, is geopolitical instability, trade wars, and then lack of disposable income for millennials. The biggest one of these is realistically trade wars and geopolitical instability, right? The general concept there, as you charge everyone else, as you make it more difficult for companies to turn profits, as you raise their cost of doing business, they're going to do one of two things. They're either going to take that and put it onto their consumers and say, we got charged an extra 5 cents, we're going to charge you guys an extra 5 cents, right? Or they're going to take it as a hit on their profitability. They're going to do what they've done since the 80s, which is they're going to lay off some workers, right? And we're going to kind of expect to see quite a few things from that. One of the ones that we can expect to see is an increase in layoffs. We can expect to see a little bit of a return of the decrease in overall consumer spending as a percentage basis that we saw in the recession and afterwards, right? The millennials that grew up during the recession, we have economic data right now that says that they do not spend as much disposable income as previous generations. They grew up in this area where they were being molded by their parents, their families, aunts and uncles, whoever, really struggling economically. So they're a little bit more hesitant to go and spend their money. Not on everything. I'm a millennial myself. We don't spend all of our money perfectly, but to a degree, it does come into play, right? And that's something you still see to the current day. And if you have another recession, I think it'll get even a little bit more extreme, right? And it's overall about when you reduce the amount of money that people pump back into the economy in any way, shape, or form, it's going to reduce the overall economy. And that's something that will affect the real estate market, I think, and a lot of the experts I talk to, more so than the direct impact like we had with lending issues and those kind of concerns in the mid to late 2000s, right?
Right. Absolutely. Absolutely. I mean, just to kind of piggyback on your comments, Stephen, actually, by the way, we are now in the longest recession, growth trend in history. We passed the 4,571st day on August 22nd. Well, you and I were in Vegas. We cleared that benchmark. And if you think about 4,571 days, that's over 10 years, right? That's over 3,600 days. So this economy is booming and growing, and it's only natural. I mean, normally we would see over the last 50, 60 years a correction about every 5 to 7 years, calendar-wise. And here we are 11 plus years in to a boom economy, a bear market. So the the other element of that is then, okay, how exactly does that affect real estate specifically? When you start looking at rising interest rates, going from 3.5% or 4% 30-year fixed residential interest rates to 5.5%, 6%, 6.5%. Obviously, the cost of housing to an average family goes up significantly. I mean, if you think about it, going from a 4% mortgage to a 6% mortgage is basically a 25% increase in monthly payment, because you're about 25% increase in the actual interest cost of that loan over time. The second element of that is obviously the limitation in housing, and most of that is driven by continuing steady birth rates, but also increasingly higher immigration rates, especially if you look back over the last 8 years or so under the previous administration, where immigration policy was fairly loose. Right. And that may be changing geopolitically, but there's no doubting the fact that immigration was at a substantially higher rate in the area between 2008 and 2018. And so those things are putting a lot of pressure on real estate prices and a lot of pressure on the economy, as well as there's more competition for jobs and all those kind of things. So, continue on with the conversation. What are the factors that lead to a continuing boom economy versus a collapsing recessionary economy?
Yeah. And I think you brought up a lot of good points. We have an increased population, right? In the mid to late 2000s, we had a construction boom that we really overbuilt and we oversupplied the market. And we all saw that to a degree, right? But we've now recovered from that. And I'm sure all of the people listening have run into this. I'm sure Eric has too. I see this all the time. Most markets have a lack of supply now. We're 10 plus years later, and we're really running into issues of lack of supply. Like you said, you got population increases, and then we also have an increase in immigration, right? So you have a lot more people that need to have housing. It doesn't really matter in what way, shape, or form. And there's a lot of things that change from that as the supply outpaces demand in the early 2000s, and it helped lead to the recession. And now we're in the opposite trend, where demand largely outpaces supply. Not in every market, but in the vast majority of the country. So you see a couple things happening, right? We've seen home price appreciation increase most markets for the last 10 years, realistically, maybe about 9.5, but close. Some markets that's been crazy, right? You see a lot of places in California, you see Denver, you see Florida and Texas, the home price appreciation has been really, really crazy. There's some places around DC where it's been the same. And there's tons of markets that have been in that boat where, from the data that I've seen from 2016 to 17, there was a 6.5% increase in the average home value across the U.S. It went up to $203,400, which is a 6.5% increase, right? Just within that 1 year. That's about twice what most experts say is a standard healthy market. So right there, right. And don't get me wrong, it's been great for all of us for the last few years, right? You see a lot of home buyers after the recession take advantage of really low interest rates driven down by central bank policy to take advantage of that for long-term refinances, right? Up until even a year ago, in some markets, even more recently, we saw a ton of refinance volume on the residential side as people were taking advantage of these low fixed interest rates. Like you said, stuff in the 3s and 4s, whereas now we're starting to see those climb a little bit more. So surprisingly, an even larger impact is being felt on the bottom third of housing values. The bottom third of houses in the U.S. rose 8.5% last year. Between 2016 and 2017, they rose 8.5%, right? So granted, that's houses that are somewhere in the range of about $100,000 to $120,000. So that's still an $8,000 to $10,000 raise in a year, right?
That's significant for a family.
Yeah, and think about that kind of pace keeping up for years on end, right? That was what was happening the last few years, and it's absolutely a great market for us to be in. You see a few things happen when that happens to home prices and home values, right? You see the average age to first house purchase, the average entry into the home buyer market is much lower because people see it as a much longer term investment. People see it as this is the main vehicle for my retirement. So they're willing to go in and invest and buy a house in their early 20s. And some places it'll be a little bit earlier, a little bit later, depending on what part of the country they're working with. That's been really low over the last 10 years or so, as people have started to realize that housing prices are going up again, and they could use that as their main form of retirement, the main form of wealth building. Because home prices and values are going up, you see the banks lower their requirements, right? Because they can hedge their risk against the home prices appreciating again, they're not as worried about if I make one or two bad loans to a borrower that's really on the cusp, or 5 years ago we wouldn't have let through. They can loosen those up a little bit and kind of protect themselves with home price value. You see a lower number of foreclosures because it's much harder to fall underwater on your mortgage when your house keeps growing larger and larger and larger in terms of value, right? When you're paying down your mortgage from a leverage basis without actually paying down your mortgage at all, it helps you, right? You see things like job loss, which has been historically low over the last few years. We've seen up to the point now, I think we're at what, roughly 4%, right? Most people that have jobs most people that want jobs have them. Some people might be a little bit underemployed, but most people that I've talked to, most places that I've run into, you have much lower unemployment. You have really low housing supply. Like we were talking about a minute ago, we had a bunch of builders and contractors that were working on improving that sector of the market and building at a crazy pace in the 2000s. And that stopped basically right away in the recession. And now we need it again, right? And you have really high housing demand as you have this whole new generation of millennials that are moving into wanting to buy houses. But you have an increasing life expectancy for baby boomers and the generations above them. You have a growth in really biotech and all these kind of things that are helping people live longer, helping people live healthier lives. So even the supply we did have is also still being occupied, right?
Absolutely. Yeah, I mean, it's. I think David Licken is the one who's shared a lot of information about that recently. I also heard Rob Chrisman talking about it at one of our conferences earlier this year, and I think a lot of that has to do with, the general cycle was people would buy a house in their 20s or 30s, they'd sell it in their 60s or 70s, move into the retirement home, and pass away in their 70s or 80s. Now we're seeing people staying in their homes until their 70s, 80s, and sometimes even 90s. And instead of having to span basically a 2-generation cycle, we're now having to stretch over a 3 or in some cases even 4-generation cycle before those homes are turning back over into the inventory. And that combined with the population bloom and the generations of the last 2 cycles, as well as the immigration that's happening with millennials, it's put a tremendous amount of pressure on housing. But when we look at the stack up of these two things, at what point do we reach a breaking point where the average American family checks out of the home buying process because homes have just become so far out of reach from an affordability standpoint? Yeah, and that's really what we see kind of as the opposite side of the scale, right? So on the first time running through, I ran from the top down. Really on a market correction, it actually runs the opposite way. You see a slowdown of demand, right? So you see fewer people are able to buy houses. You see maybe a little bit of a higher job loss, a little bit more underemployment, so people make less than they normally would be able to. They're not necessarily able to find the perfect job for them. You see the banks starting to tighten up their requirements a little bit, right? As more and more of their people, more and more of their borrowers and clients maybe are underemployed, they're struggling with their mortgage, or completely go underwater on their mortgage, the banks tighten requirements to combat that change, right? So you see more foreclosures as people run into issues with that. And then because you have lower and lower demand and you have a tighter banking restriction on who can get loans, you see an increase in supply as well. Once you get to all of those combined,
it makes it tougher to get loans. The jobs that people do have, you see a lot of wage stagnation, you see some unemployment, you see some layoffs. That's going to make it tough for the average person to get into their first house, right? And then because of all of this, you see the home prices fall. Right? As you have less and less demand, the supply stays roughly stagnant or maybe even increases a little bit. Banking regulations increase a little bit. You start to see demand fall, and the average person has less of an ability to afford a house than they did a couple years ago, right? And that's kind of what people expect on the market correction side, where a lot of it will be driven by changes in demand rather than really issues in predatory lending or any of those kind of things like we saw a little bit during the 2000s. It'll largely be driven by the changes in demand.
Absolutely, absolutely. So obviously, either market, there's going to be opportunities, right? It's kind of like whether you feel it's taking advantage of it. Warren Buffett's famous statement about buy when there's blood in the streets, right? Well, it's stock market collapses. There's going to be opportunities to pick up equities at a fire sale, liquidation price. Which obviously, benefits real estate investors. On the other side of it, if the average homeowner or the average American family is being squeezed beyond the point of being able to find a livable home they can buy, then who does it benefit to, and who's going to be able to kind of profiteer off of that cycle of market? Why don't you kind of shift towards that solution side of the conversation at this point, Stephen?
Yeah, absolutely. And really, as we were talking about, as we're working through market correction, you see the average home price goes down. You see fewer and fewer people trying to get into that home buyer market. You see more people forced into renting maybe. And who comes to mind is who profits from that, right? Yeah, I mean, what do you think, Eric? Who comes to mind?
Exactly.
Yeah.
I guess it kind of goes back to that conversation we were having a couple of weeks ago about, the last recession. There were two groups of people who benefited fabulously. Now, I do feel sorry for the homeowners whose property values went from $1 million to $100,000 in 6 months. Obviously, that was not the funnest situation in the world for those families, but yet those families are still going to need a place to live, right? And especially in a tightened credit environment, if you've had a foreclosure or a short sale in recent history, 2, 3, 4 years, you're going to be trapped in kind of a rental situation. The landlords are the ones who benefit from that. However, home buyers who had been squeezed out of the market for years and years and years were able to pick up some good properties at 10, 20 cents on the dollar. So there's a huge opportunity boom market there. The other group that did really, really well, and one of the first groups to really come through that market was the real estate investors, the particularly profitable investors who had quite a bit of cash on hand, in addition to having a healthy portfolio of hold properties. Because the issue with investors, right, is am I a fixer and flipper, or am I a buy and hold? Or do I have a mix or a healthy balance of both, right? The most profitable investors were the ones who had good equity positions in profitable, net income rental properties that were more of their hold portfolio, but also had plenty of capital to pick up the great deals that they were able to pick up during that time. So you had mentioned to me even just before we started this webcast, Stephen, some thoughts about that.
Yeah, so really part of the foundation of RCN as a company was our own owner had his own investments kind of across the nation to a degree, and was struggling to find financing. So to a degree, that's where we came from, right? We said, hey, this is a problem that probably exists almost everywhere, right? So that's where we came from, and we started to grow as fast as we could to try to help as many people across the nation get back on their feet, get going, and take advantage of this great growing market. Now, on the other side of that, as we were talking about, even in a downturning market, the real estate investor can do really well. You have a lot of positives. You have the average home loses value, so they're buying cheaper. they have a lot less competition because the average home buyer is taking longer to purchase their primary residence. They're taking longer necessarily in between properties. So instead of buying another property every 7 to 10 years, maybe they bump it upwards 10 to 12 years is the average time between house purchase, right? You're going to see increased regulations, which don't affect investors as much. The commercial side is a little different, right? You see a large influx of people switching from owning to renting, meaning that rents don't really drop and they don't have as many issues with vacancies because you have more competition as a landlord for your units. Now, I'm not going to say that a recession is perfect for an investor, right? There are some negatives. Their current portfolio is going to lose value. So they've got to make sure that they're not over leveraged with their current portfolio. So that way they can afford to take a little bit of a hit on their current values, right? We want to see, and you guys would want to see as well, that they've got some liquidity. They've got some leverage to play with. They've got some skin that they can use to kind of get in on some of these loans on smaller properties or ones with slightly lower values now. So if the average price in your area is $300,000 and it drops to $250,000, we want to make sure your existing portfolio can cover that drop. And then you also have the liquidity and the availability where you can take some of those funds and go buy more properties. Now they're $50,000 cheaper than they used to be, right? The only other real negative is that regulations and lending requirements do tighten during a recession. It's kind of expected. But right now, the last I checked, a lot of investors are buying in cash or they're not buying fully leveraged anyway. And a lot of them are not working with your Bank of America. They're not working with your really large corporate banks. They're working with small guys in their area. They're working with a lender like RCN or one of our competitors that work in a smaller space. And on something like a recession, as you have an incredible increase of supply, every investor I talk to, one of their biggest problems is finding the right deal, right? As you increase supply and you decrease demand, because we have people that are building houses now to try to compensate for existing supply problems, but you also will see a decrease in demand to a degree. We'd want to see, these guys are going to start to succeed at a higher level because they're not going to run into the same issues with struggling with supply. Now, and we were talking about this a little bit a couple of weeks ago as well, Eric. One of the things that's going to come into play now is how people actually go about this, right? So in a second, we're going to go about what it'll look like in a continued market growth scenario. But one of the things to keep in mind is that the way an investor, and by extension, the way you guys go about targeting them, is going to be different. The way they function is going to be different depending on what the market's doing. So in a market recession, you might see a slightly different avenue where you see people buy a few more properties, hold them long term because the rents are really high relative to housing values. You might see them renovate things a little bit so they can get tenants in there and then sell them off in a few years, banking on that increased appreciation as they go, knowing that any recession is eventually going to turn around and go and increase in value. So what do you think? What do you think the biggest things are going to be looking out for in the next couple of years?
Well, I mean, obviously the need for capital is going to be an important one. The other element of that I think will happen is in a booming market is there's going to be significantly increasing demand for rental properties. So I think you're going to see a lot more investors in a boom market shift a greater percentage of their portfolio to more of a buy-in long-term hold strategy and shrink the volume of activity of capital they're putting into fix and flip type stuff. I mean, everybody thinks that a lot of people think of investor real estate fix and flip as sort of a get rich quick scheme, somewhat unscrupulous, and of course it wasn't certainly helped by the fact that our country over the last 4 years has had a bunch of info marketing guru guys selling that kind of the buy real estate, no money down, get rich quick, Carlton Sheets style of approach.
Yeah.
But the reality is it is a great way to make a quick buck in a booming market if you can find the properties. But like you said, the property liquidity and the property accessibility is going to be, part of the problem. And that was one of the major factors that really kind of made the last recession so severe that likely won't be a factor this time around because of ability to repay and some of the change in regulations. I mean, you think about, like, there was a question asked by one of the attendees a few minutes ago, I typed a response to, but the reality is, part of the reason we had that hyperinflation in real estate in those high cost markets like San Jose, California, and South Florida, and along the Northeast corridor up towards Boston and that area, is because you started seeing this because credit had gotten so loose, and because you had so easy access to really cheap capital for speculative investors. I remember hearing about a process that was taking place down in South Florida. They were calling them contingent sales. Somebody would sign a contract to buy a property for $300,000 today and turn around and sell that contract to a secondary buyer, within 15 or 20 days for $400,000, never having taken, full title to the property under the first contract. And it was because because the lending guidelines has gotten so ridiculously loose, and it was just, anybody who could fog a mirror could get a loan, whether it made sense or not. With common sense having gone completely out the window from an underwriting perspective, that's part of what created that hyper overinflated markets of the previous recession. We're going to have that this time because, loan officers who do that are going to be subject to criminal penalties, and their MLS number is going to be on those loan applications. But for responsible investors who know what they're doing, and for lenders who understand the potential capital increase of taking a dilapidated property that needs some renovation and love, but so there's two things to that. One is you're going to see investors doing much more of a long range buy and hold strategy in a boom economy, because it's going to get increasingly more profitable to do so as housing affordability shrinks. Secondly, is you're going to see a lot more responsible use of capital in the properties that they do acquire and do renovation to as part of their real estate portfolio strategy from that perspective. Yeah. Would you agree, Stephen?
Oh, absolutely. And that's, based on what we already talked about earlier on in the webinar, you're going to see if your house that you own is appreciating without your help, you're not going to do anything to it. You're just going to let it sit and appreciate, right? So a lot of people, or you're going to try to get a house that you own that isn't appreciating into a range where it can appreciate. So you might have to do some renovation and then go and hold it long term. But I would expect to see, and I think to some degree we already are kind of still seeing, a lot of the real estate investor market transitioning into these longer term buy and hold scenarios. You have longer term cash flow, you have longer term appreciation, especially in these markets that have really strong appreciation. You have places like Denver that has really jumped up over the last 20 years or really more closer to the last 10 years or so since the recession. Their values have gone crazy high. You have places in New York that have done the same, right? I know people that have bought properties in the Bronx 5 years ago that now they've gained $200,000 on their property in the last 5 years. So on something like that, why would you ever flip it, right? Unless you absolutely need the cash day one. And that's fine, right? So one of the things that I wanted to bring up in this one is, there's a lot of different avenues and a lot of different positives for investors in a growth market too. You've got average house gains value. You've got low supply, like we talked about. You've got rents that aren't really dropping. As we saw even during the recession, rents didn't really drop at all. They dropped a tiny bit maybe in some markets, right? But everyone still needed to live somewhere. And especially as people had to get out of their houses from foreclosures, we didn't see a decrease in rents because the demand stayed roughly the same or even increased.
However, what we did see was a drastic reduction in residential purchase owner-occupied transactions, because accessibility was just, somewhat limited in those days. People who just lost their house or had a recent foreclosure under that, credit restrictive kind of the overswing of the pendulum where guidelines got so ridiculously conservative for those first couple of years of the recession, made it really tough for a lot of families, and they didn't really have much choice other than to rent.
Yeah, and that's part of what started this whole webinar concept in general between the two of us, right? We were talking about how the average home buyer was impacted by the recession and how we expect that to realistically happen in the future. And the fact that a lot of the originators we can communicate with, a lot of the people I talk with in the industry are, to put it a little aggressively, maybe a little overexposed in the residential market. If you struggle there and people are struggling to find houses to get qualified for mortgages, it's going to impact your business to a degree, right? And that's really the goal for us at RCN, and the goal for the whole webcast is to see what we can do personally to help you guys capture this market, to help you leverage your business and help keep you on a growth path, right? I don't expect this to be everything that everyone on this webinar does, but I want all of you to kind of keep this in your mind, keep it in your back pocket. If you start to see changes in your market, if you start to see opportunities even in a growth market, keep this in mind. This is another way you can diversify your business. It's another way you can grow in a changing market. So Eric has kind of alluded to it a little bit. We kind of expect to see two main strategies for real estate investors. And it's really what we've seen over the last 10 years or so, even a little bit before the recession as well. You see fix and flip, and you see long-term rentals. So it's really the fundamental question of, if I put in a lot of work now, what can I get out of it for a quick buck, like you said earlier? Or banking on home price appreciation in a recovering and accelerating growth market, right? Now, the good news is RCN can do both, right? We have loans specialized in fix and flip products. We have loans that work with rental investors for long-term options, 30-year fixed rate mortgages that give people an incentive to take advantage of the rates now, even as they're climbing, right? So you see residential rates that are at what right now, right?
Yeah, I mean, owner-occupied, low to mid-fours for somebody with great credit and a reasonable down payment equity position.
Yeah, and I will tell you right now, I mean, we'll get to it in a couple of slides too, but for our 30-year program on an investment commercial loan, we're looking interest rates between 6 and 8%, right? It's not unforeseeable to see interest rates in a couple of years climb to that level, even on owner-occupied mortgages. So if investors can get in now and take advantage of really strong rates, that's a huge boon to their ability to cash flow long term, right? Now, the big one I want to cover right away, because I think it's a bigger play currently in the market, and especially in a lot of markets, as you see, we're still struggling with issues of supply. So people are taking houses that aren't necessarily dilapidated, they're not destroyed or anything like that. They're just, the last time they were renovated was in the 60s, 70s, 80s. So people are taking these houses that are really just out of date, not out of code, and they're bringing them up to speed. So one of the things that we can do is what we call our after repair value loan. So this is used for your fix and flip investor. We go up to 85% of the purchase price, cover up to 100% of the renovation costs. We can do 1 to 4 families. We can do 5+ units. We can do condos, townhomes, mixed use properties. If it's got a residential component in it, we're going to take a look, right? It's a term of 12 months or less. Loan amounts anywhere from 75 to about 2.5 million. Now the top end of that's a little soft, right? If you bring us to 2.6, we're not going to push you away. We want that to close just as much as you guys do. On something like this, this is not the Wild West, right? This is not the mid to early 2000s where we're going to give a loan, like you said, to anyone who fogs a mirror, right? We are looking to make sure that they're still making a cash return on it. We want to make sure that they've got a solid profit built in, which is why we have the LTV requirements no higher than 75%, right? It's also why we look at credit score, because if someone's got a credit score in the 400s, if they've got something in the low 5s, usually it means they're not paying anyone now, right? They're struggling with payments currently, and that's what we're looking at. You know, if you got a bankruptcy 5 years ago, I could care less. If you're paying everyone now, that's what we're looking for, right? The other sides of it are we want to see experience. If you have it, that's great. It increases leverage. It decreases interest rates. So your new investor would get usually about 75 to 80% of the purchase price, a little bit higher interest rate, right? The other side of that is cash reserves. So if you have the cash to close these, that's what it comes down to. These are not down payments on your FHA loans. You're not looking at 3.5% to 5%, right? There's a little bit more risk on our end, so we want your investors to share in that to a degree, right? So here's an example of what that looks like in practice. And I would say this is a pretty common scenario, right? You see a purchase price of $100,000, you see a renovation of $30,000, that's going to be largely cosmetic. You're going to see updates to the kitchen, the bathroom, you might see wood floors put in, you're going to see fresh coats of paint, you're going to see some landscaping, and there's your $30,000, right? Credit score of 680 is perfect for us. The borrower routinely flips 5 properties a year. That's amazing experience on our end. That easily qualifies for one of our best pricing tiers. This would be a 12-month loan, no prepayment penalty on that with a fix and flip loan, up to 85% of the purchase price, up to 100% of the renovation costs. So we're covering $115,000 total when their total cost is $130,000. That's not too bad. Down payment is roughly about $15,000. They got closing costs in this case of about 10 grand, which would be 2 points for RCN and 2 points for the broker. And then they receive $85,000 at closing, and the full renovation is held back in draws. So our draw system is basically a reimbursement system. As they complete a percentage of the work, they're reimbursed that amount of the money. So they submit a draw request. We send an inspector out to the property. They take a look. They say 18% of the work is done. We give 18% of the funds. It's that simple, right? It's really not that drawn out. We like to make it as easy and as simple as possible. This is a very common scenario in today's age, especially in a growing market, where the bigger issue is taking properties that are at the lower end of their market and trying to raise them up to the higher or the upper middle part of their local market. So if the high-end houses in your neighborhood are selling for $300, you buy a house for $150 and you try to bring it up to that $280 to $300 range, right? That's the goal of a lot of investors. It doesn't mean that the $150,000 house wasn't livable. It just means that it wasn't ideal for the average person. And that's something we're starting to see currently, and we have been for the last few years, that we really expect to continue in a growing market. Now, in a downturning market, you might see a little bit different, right?
Yeah, absolutely. Well, and I'm going to hold you off on the downturning market for just a second, because there's one key point from a sales perspective and what this means from a loan officer and how does this help you mindset is, think about those customers who have been rejected on multiple offers. They only qualify for 2 or 250, and maybe if interest rates go up another half point or 3/4 of a point note rate between when you initially pre-qualify them and they're on their 7th or 8th house 6-7 months later, what about helping them find an investor who will help them do some renovation on one of those Class B properties that's been sitting on the market for 5 months, despite everything else in the market having sold in 30 days or less? Because they're not able to, as interest rates increase and as property values continue to remain growing or stable in your market, more and more and more of those customers are not going to be able to find the homes they want in the price range they qualify for. And that's where collaborating with investors in your market and in your community can be a huge way to help your borrower customers as a residential originator compete against the housing liquidity problem by kind of being matchmaker for those two different folks coming together. It's a great way to make some things happen. In my origination career, I used to do that with home builders and investors all the time. Another great example would be when you've got the homeowner who is just not ready to qualify for a conventional or conforming loan right now. They need seasoning because they've only been self-employed for 3 months. They may have decent credit. They may have plenty of money for down payment, but it's a little harder to get them a deal because they don't meet either the non-QM loan box of an experienced self-employed person or even the conforming limitation requirements. They just need to sit and season for 12 to 18 months. Well, introduce them to one of your longer range investors who's got some property he'd love to liquidate, but doesn't necessarily want to have to sell it at a significant loss. let them get in with a contract for deed that gets rolled out 18 months later and allows the home buyer to take advantage of some of the equity appreciation along the way. Those kind of things. So, Stephen, you were just about to shift into the conversation about the declining market, the collapsed market. Then what?
Yeah, so I just want to make a point on that. You brought up a great opportunity for a lot of these people that have, attended our webcast today. You can play both sides of this. You can help your existing residential business by working with investors to provide additional supply when supply is stagnating or struggling. You can work with investors that provide supply at the top range. You can work with investors where you can actually introduce them to the end buyer, and the end buyer can say, I want the kitchen to look like this. I want the bathroom to look like this. Whatever the case is, you can introduce and play both sides of it. You can finance both sides of it, and you can keep both relationships going, right? So it lets you as an originator have one more avenue, not just to add to your business, but to actually improve the existing functions of your business, right? The investment side, the commercial side of your business can actually drive the residential side of your business even higher. And that's something we see definitely with the fix and flip model, where you can have investors come in and help repair parts of the neighborhood, help bring the properties up to speed and really into this century for some of them. It's just such a big opportunity that you guys can take advantage of. And on that, talking about where to find these investors, where to go, one of the things that I would recommend, one of the biggest things you got to keep in mind is you really have two different options, right? If you're trying to find investors to both help your commercial business or help potentially start your commercial business, but also use that to help leverage your residential business, you've got two different options. You've got other referral parties. You've got your other brokers. You've got mortgage originators, MLOs, your other lenders, attorneys, CPAs, financial wealth managers, the whole gambit, right? On the other side, you have your primary channels. You have personal contacts and referrals. I'm sure all of you have massive networks of people that you've worked with in the past. You probably already run into investors, developers, and builders in your network, in your local area. Those guys talk to each other. They stay in contact. They compete against each other, right? They all know who each other are in their local market. So if you can get one or two of them in your local market, get them happy, a lot of times they're going to keep talking to the rest of the group, and you're going to get opportunities there too. Now, one of the things that I like to bring up, while a lot of you are absolutely going to focus on the primary channels, and you absolutely should, right? You have a benefit to borrowers where you can do a level of education that RCN can't do and no lender can do, right? You can have people in your office. You can have people on the phone much more often, much more commonly, and much more in depth. And you have a lot of ability to help these people bring them up to speed. But do not forget the secondary channels. This is the commercial world. We have no issues paying referrals to people. We have no issues paying fees to anyone who's connected to the loan. So even if they're a residential mortgage loan officer, if they're working exclusively on the residential side, they can still get paid at closing, right? That doesn't violate their licensing. It doesn't lead to any issues. So that's something to keep in mind that a lot of residential workers in our industry don't understand. Or if they do understand, they just keep it in the back of their mind because they think it's a skeezy way of getting around something. This is how things operate, right? It is one of the key ways that we function. Now, we talked a lot about how to get into those kind of markets for flippers, but I mean, realistically, what we're seeing a lot of now and what I expect to see even as prices fall a little bit and you get people that can buy at really low prices with still really high rents is the 30-year program. You see people that are looking to hold these properties longer and longer term. So on this, we can do 1 to 4 families, condos, townhomes, and planned unit developments. It is a full 30-year term. It is fixed interest rate, anywhere from 6 to 8%. That is fully amortized all the way out to 30 years. We're looking loans anywhere from $75,000 to $1 million. We can go up to 80% of the purchase price on a purchase. We can go up to 75% for a rate term refinance. We can go up to 70% for a cash out refinance. We can also do the variety where someone starts it, renovates a property, decides they want to keep it, and then refinance out from there with this program, right? That is an option as well. And it gives people a lot of flexibility to, after they go and do the renovation, hold something, much lower interest rate, much lower monthly payments, right? A little bit more stable.
Awesome.
So now the big couple questions, right? This is absolutely going to help your clients. This is absolutely going to help you expand the number of people you work with. Now, most importantly, what does it do to your bottom line, right? We have several different options. So the standard one that we see most people take that are used to our industry is what we call splitting points. So if we can charge 4 points on a transaction, RCN would take 2, and whoever's the broker would take 2. If you're an MLO or whatever the case is, if you're brokering the transaction to us, you're the one who's being the middleman between us and the borrower, you would get those 2 points on the other side, right? That means you're going to help us explain things to the borrower. You're going to bring their questions to us, whatever the case is. It doesn't mean you have to be an expert. If you're going to take this opportunity, leverage our experience. You do not have to be an expert in this area. Let us know if you have questions and issues. But the idea is your borrower is your borrower, and that's how we want to function. We want everything to run through you if we can, right? Now, the other side of this is if you really don't want to focus on this, but you get these opportunities across your desk. So this is a referral fee. We will pay out usually about half a point to anything that closes that you brought us in. So we're looking for minimum information. That's purchase price, the property address, current value, after repair value, renovation amount if that's applicable. We want to see credit score, maybe cash reserves and contact information, right? If you give us all that information and that closes, we will pay you out half a point every single time. Now, the great news is you never have to decide which one you're going to choose from now on, right? If you normally split points and you've got a busy week coming up, you're going to go to a conference, you've got a lot of other things to focus on, or even just it's summer and your volume starts to pick up, right? Or whatever the case is, and you want to switch to referral fees, that's absolutely an option. If you want to do referrals until you get more comfortable with the business and how we operate, that's absolutely an option. Whatever works best for you guys. Our goal is to have your compensation be dictated by how much involvement you put in and then run from there. So we want to try to make it easy on you if that's an option, that's what you want to go after, but also give you high levels of compensation if you're willing to really partner with us, right?
Absolutely, guys.
Yeah.
Stephen, I want to interrupt you just really quickly, though, because
Sure.
I know you've got some special offers for the audience, and I know we're getting awfully close to the top of the hour here, and I'm assuming there's probably some people that are going to have to jump off for other appointments or whatnot. Can you just very, very quickly highlight how do people get connected with you? How do they begin to go down the path of doing more of these renovation investor loans with you guys? And then, we'll get back into the Q&A mode here in just a bit, folks. But I know there were a ton of questions coming through about how do we contact you, where do we get started, how do we find out more information about the variety of products. There was even a question in there about I've never really done a lot of these. How do I start to dip my toe in the water with it? That kind of stuff. So how do they get a hold of you guys?
Yeah, so the single best way to do it, you have my email up on the screen right there. Shoot me an email, right? We also have in the resources tab, if anyone is interested to get it signed up with a broker, we have a page in the resources tab that explains our broker program in depth and runs you through how to get signed up. If you're confused, if you're not sure, you have my email right there. Feel free to reach out to me, right?
Right, absolutely. Also, by the way, folks, when you exit the platform or when you leave the webcast, the survey will pop up automatically for you. And there's a couple of questions if you'd like to schedule an appointment or have the RCN Capital folks contact you to schedule an appointment for more in-depth personal Q&A, one-on-one type of call. Just make sure you fill out that survey question and respond. By the way, we do want to encourage everybody to make sure they take advantage of the opportunity to complete that survey at Originator Connect Network. We're adamant about trying to constantly evolve and improve the quality of programming that we provide to you. It's vital to us and to our sponsors that we get that feedback from you. So RCN has graciously sponsored to offer they're going to do a raffle drawing of a special special prize packet that they will coordinate getting to either by mail or meeting you in person at an upcoming conference, live conference, to hand that information to you. Approximate value, Stephen, on the prize package that we're talking about here? And by the way, anybody who fills out the survey is going to be entered into that door prize drawing.
Yeah, so anyone who fills out the survey will be entered into the drawing. I go to a lot of these conferences myself, so if it's a case where whoever wins is going to a conference coming up through Originator, I'd be happy to meet you in person and deliver it then, right? Otherwise, we can always mail it in, whatever works on your end. So the approximate values of this somewhere around $25 to $30. It's a bunch of just tokens of our appreciation from RCN. We had a couple things. We have a stylized mug, actually, which is one of my favorites in there. A couple other little things. Hey, you have it. That's amazing.
Yes, I do.
So we got one of the water bottles there. We also have a specialized coffee mug. That is in there as well. So that's something we'll be doing. Anyone who does the survey, I will raffle through and just randomize a winner, and then I'll reach out to them directly. I know We're running into the top of the hour, so anyone else who has questions, we will be answering questions in the Q&A as we can. And then we will follow up, either myself or the rest of our team will follow up with you directly. If you have any questions, if you have any more information you're looking for, you have the resources tab you can look through that lays out our loan programs. It also gives you an option of having all of our templates, all of our templated marketing materials are white label. So you can show fix and flip and all these kind of programs as your own, including our own matrix. So I'd like to invite everyone to go and take a look at that. We have the broker page in the resources tab as well that shows you how our program works, how you get paid. And then also, I will make sure if anyone is looking for it, I will offer the slide deck as well. Send me an email if you have questions or you're looking for that as well. And then if you're interested in this, absolutely go to one of these conferences, right? Go and check it out, talk to ourselves, talk to other people in the industry. Absolutely recommend, if this is something you're interested in, go to local investor meetings, go and meet the investors in your area and figure out where you want to go from there. That's a huge group of experience you can go and find out. You have two options there. One is REIA, REIC. You have Real Estate Investors Association and Real Estate Investors Club. Both of those are huge, and they're a great avenue to jump into. Other than that, whoever has questions, send them to me by email.
Absolutely. All right, guys. So a couple of quick things to piggyback on what Stephen just said. These, by the way, REIA is one of the largest national organizations as a whole, even outside of the Realtors Group. And they are nationwide. They're in most markets. They're pretty easy to look up and find a local chapter that's a very active group. The other things that we'll talk about, and by the way, I'm going to encourage, maybe even twist your arm a little bit, Stephen, that you come back for a future webcast with us where we go really deep on where do you find the investor, how do you build those relationships? How do you provide the quality of support that they're looking for to be able to help them grow their business? We'll do sort of a build your investor business type of webcast down the road. And I don't mean to put you on the spot. If you're not up for that one, then we do have some other sponsors we can go grab. So anyway, guys, the whole point of this, guys, is that we're trying to provide programming to you that's going to help you grow your business. And one of the best resources that I know of in this sector is the guys at RCN Capital. That's why we personally invited them to come be a part of this project. And they've done an amazing job stepping up to the plate and providing support. Keep posting your questions in the Q&A as we go. Stephen, I hope you've got a few minutes that maybe we can knock out a couple of the high-level ones that are probably in the mind of most of our audience today. But if you do have to jump off, audience, just be watching for future updates and events that we're going to be offering here in the Originator Connect Network. We wish you all the greatest of success. And if there's anything that you are looking for information on or training about, please make sure you post those comments in the survey for us so we can use that information for follow-up. All of the tools and resources, if you haven't already downloaded, but before you check out, I would strongly encourage you to hit that resources tab. It's the icon that looks kind of like a Word document with a green border. That will open up all the resources that RCN and Stephen were talking about just a few minutes ago. Otherwise, Stephen, what do you say we jump into some of these questions? If you have about 10, 15 minutes to hang with us here?
Oh, of course.
Okay.
Yeah, I'm more than happy to jump in and have the conversation about if people are interested in this, how to dive deeper into this market, right? That's one that, I will absolutely be doing more training on, more thinking on myself. That's something I do at RCN, obviously. Most of what we do is focusing with brokers, but we do work with direct borrowers a little bit. And I go to these events myself just to keep a pulse on local groups and where the market's headed. So I go to one in New York, or I realistically go to a couple in New York. I go to a couple in Boston, which are both next to me. I'm in Connecticut. So I go to a few of these events myself just to keep a pulse on what's going on in the industry. And I would recommend it to anyone to go and check it out, even if it's something you're not sure you're going to jump into. But there were a couple of questions that came through. I want to jump on a couple of them right now.
Go for it.
The first one that I see is, can we please get a copy of the slide deck? Absolutely. If you're looking for the slide deck, we do not have it in the resources tab, unfortunately. That would have been a smart thing to do, but I forgot about it ahead of time. So if you're looking for a copy of the slide deck, send me an email. I'm happy to send it to you. All right, what else we got in here, Eric?
There were a couple of product-specific ones that I was going to ask you about, just to kind of touch base. Michael had asked the question about, how often portfolio or hard money private equity lenders, whatever you want to call them, transition from starting with residential, moving into larger cap multi-unit properties, and even into retail, office, and other commercial property. How far do you guys go with that?
So RCN really just focuses on the residential aspect. If something gets to the point where it's commercial, if it's warehouse, if it's office building, whatever the case is, we don't really do those. Now, I will say I know a lot of lenders that do work in that space. So if you get to a point where you're having your borrowers that are expanding into that space, let me know. I'm happy to introduce you, right? The other side of this is one of the biggest benefits you guys can provide as that referral, as that brokering source or originating source on the commercial side, is helping these guys every step of the way. So as they have issues, you guys can introduce them to the people who are going to help them stay successful. Doesn't matter if RCN takes a guy that does 0 flips a year, we get him to do 1, working together, and then we start getting him up to 3 a year, 5 a year. We get him to a point where he starts doing a bunch a year and wants to transition to the commercial world. At that point, we've had a great relationship with him in the past. I will gladly introduce you with other lenders that work in that space, and best of luck, right? That's an advantage that as a broker, you should absolutely be leveraging, because you can help these people no matter what they're looking for. Once it gets to a point, if they're largely focusing in, loan amounts above what we do, if they're looking for $10 million apartment buildings, if they're looking for larger office spaces or whatever the case is, we can't really help anymore, but you guys still can, right? That's a huge opportunity.
Absolutely. Absolutely. So, a quick question, John Ramsey, the marketing materials that Stephen was mentioning, some of them are in the actual resources tab. Again, that icon that looks like a Word document with a green border. You can download some of the marketing materials that they've already provided in the resource tab, as well as I'm sure Stephen's team will kind of follow up with you guys to make sure that you know how to get access to the rest of their white label marketing tools and flyers that you can use to help you promote the investor loan product services in your market. Another quick question that came through here, Stephen, that I was going to kind of pepper you with. There was a question about unique borrower and borrowers who may be going a little outside the QM box qualification requirements. Do you do, for example, like foreign national investor property loans?
We do foreign nationals. So we can work with people who aren't a U.S. citizen. We can work with people who have legal status. That's not a problem at all, right? We do make those loans at a lower leverage than we would your average American citizen. The reason why is they're a different structure. So they have to be a non-recourse loan instead of a recourse loan. It's a little bit more risky for us to do it, so we want to reflect that in a little bit lower leverage, right? But we're absolutely open to it, and that's a huge benefit in a lot of markets. You see a lot of foreign investors are investing in the U.S. I see a lot of Chinese and Russian investors especially, but you're starting to see a lot of Latin American investors as well. It's a growing market really all across the nation. So it's absolutely something you guys can take advantage of, and it's something we're happy to help with.
Absolutely. Yeah, because you're seeing a lot of the minor trends. I mean, as long as they're not like on a CIA terrorist watch list, you should be all right to be working with some of those foreign entities. Yeah, I mean, of course, we always want to watch out for the money laundering schemes and stuff like that. And that's part of our, FinCEN responsibility as originators to make sure that we're keeping an eye on those things. But if you've got good protective policies in place, it's not a difficult area to play in, particularly if you have something in common with those markets. I mean, if you, if you are a Russian native who immigrated, 15 years ago and you're now a naturalized loan originator, but you have a bunch of contacts over in Russia that want to buy investment property here in the United States, go for it. You know what I mean? I'm always an advocate of use what you got, leverage your talents, abilities, knowledge, relationships to the fullest extent you possibly can to help others. And you'll be graciously rewarded as a result. Okay, Stephen, any other questions you see in here that you really want to make sure we tackle before we close this down? Folks, continue to keep posting these. We will receive notification and updates on these as we close down, and I guarantee you, Stephen and their team will make sure they reach out to you and get those questions answered. Stephen, were there any final ones you saw on the list that you really want to tackle?
So one of the big ones is talking about the renovation portion of it. They're asking how many total draws we allow. We do not have a minimum or a maximum number of draws. So if you feel like you need to take one draw, that's fine. If you want to take 15, that's fine too, right? Whatever works in terms of how your renovation system is structured. There are a couple benefits to taking fewer draws, right? There's a $200 cost per draw that is taken out of the renovation budget, right? It is not paid out of pocket. So if you think you're going to take 5 draws, you put an extra $1,000 in the renovation budget and you're covered, right? The other side of it is you are not charged interest on a draw until you actually receive the funds. So if we have the scenario we had earlier on in the presentation, $100,000 purchase price, $30,000 renovation, you are not charged interest as a borrower on that renovation funds until you actually have them in hand. So that gives you a little bit of a benefit to take draws a little bit more slowly, a little bit larger, because you're not charged interest on the funds until you actually have them. We're pretty flexible with the renovation program on the draw side. We try to be as flexible with that as we can.
Absolutely. And the more experience you are with it, the easier it'll get to be able to coach your investors on what makes sense. Some of it, I think, has to do with the scope of the project too. If you're going to have to do, $15,000 worth of plumbing work before you can really do anything else, and you're going to have to basically rip the walls bare, back to studs on the project, you're probably going to need a few more draws than if you're going to be just a simple kitchen renovation or something like that. All right, guys. Well, there was one last question that was asked in here, Stephen, I want you to tackle, and then I'm going to kind of make it last call for everybody because we do need to be closing this down here fairly quickly. Can a buyer purchase in their business name was the question that was asked by, I'm not going to pronounce that name because I'll probably butcher it. Keisha, I think. I'll apologize in advance if I mispronounce that. But the question being, Stephen, can investors or borrowers put it in an LLC or business name?
So for all of our loans, we actually have to have them in a business entity. It protects RCN and it protects your business, right? It's the better structure from all point of view. In order for a loan to be commercial, it has to be to a business entity for investment purpose. So in order for us to make any of our loans, they do have to be to a business entity. The common ones you'll see are LLCs or S corporations or trusts. The most common of those is usually LLCs. That's something as the borrower is going through, confer with a lawyer that specializes in real estate law, confer with their CPA as to what the best structure is for them. But it absolutely has to be in a business entity of some kind.
Right. And just so you know, guys, as a broker or as an originator, even if you're with a larger national firm, that's actually a protection to you and your NMLS because it distinctly clarifies that these are non-RESPA loans. Section 8, kickbacks, referral fees, completely out the window in this product category. There's no restriction on referral fees and stuff like that, up to and including if you wanted to pay referral fees to CPAs or financial advisors who are referring you investor customers that are going to be working with you, which, by the way, is also something to think about. The next time you come across an investor client who has, 7, 8, 9 investment properties, and he's been acquiring property initially under a conforming loan structure, you might want to consider reaching out to these RCN guys about helping that customer convert it over to an LLC so he can expedite and accelerate his portfolio growth. Probably some decent capital there to be worked with as well. All right, guys. Well, thanks again for joining all of us on this webcast. Obviously, thank you so much, Stephen, for the overwhelming amount of information that you shared. A lot of great ideas, a lot of great knowledge for our Originator Connect Network members to chew on and think about the dynamic of what it would look like to prepare their business and build a solid foundation for any market that may come our way over the next 6, 12, 18 months. Guys, as always, if there's anything else myself or the rest of the team here at Originator Connect Network can do to help you grow your business faster, please reach out to us. Please touch base. Check out the Facebook page, the mortgagestory.com website, and the Originator Connect or mortgageconferences.com websites for updates of upcoming events and webcasts down the road. Stephen, I'll let you, any final thoughts you'd like to share with our audience just before we close out?
Okay. The first is I want to thank everyone for joining us, right? If this is something you're interested in, even if you just have questions about it, just shoot me an email. Let me know. I'm happy to talk about it. I also tend to go to a lot of these conferences in person. I will actually be next week at the Texas Mortgage Roundup in Dallas that is run through the Originator Connect. It's by the same group that just ran a conference last weekend in Vegas, so they're running me ragged.
Several more by the end of the year. Colorado, Utah, California again, both North and Southern California again. A couple more events before we close out the year. So yeah, come out and meet the the Originator Connect Network online engagement team and the conference crew as well. It's a great bunch of people, and we really do enjoy. I think you had one more thought you were going to share there real quick though, Stephen.
No, I was just going to say, come and see me. If you have any questions, I'm always happy to talk to you guys at the booth. Come and hang out. It's always a great time. It's a great place to learn more, to get a lot more experience, and to leverage what you're already doing, right? RCN is not the only presenter. RCN is not the only exhibitor. Go and learn more about the industry in general, right? And then if this is something you're really interested in, you're really driven about, reach out to me personally. Happy to help any way I can. Other than that, I will see everyone soon, and thank you very much.
All right. Well, thanks again for joining us, everybody. We're going to go ahead and close this out. We'll see you on the next one.